Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. The Reserve Bank of Australia's board held its final meeting for 2021 yesterday. It's ending the year with a vastly different situation than how it began. Inflationary pressures are building, the housing market is coming off an extraordinary boom, and the economy is recovering from the Delta strain thanks to a national vaccination rate of more than 88%. So, what's it all mean for the decision-making at the central bank? Gareth Aird is Head of Australian Economics at the Commonwealth Bank. Gareth, welcome back to Fear and Greed.
G'day, it's nice to be here.
So, tell me the main points out of the Reserve Bank's board meeting yesterday.
Well, look, we probably didn't learn a lot to some extent. The Reserve Bank left monetary policy unchanged, as was expected. They reiterated their view that they think it's going to still take a long time for inflation pressures to emerge. They think inflation's only going to pick up gradually. They think that wages will also only pick up gradually, and that means they think a rate hike is still quite a way away. I mean, I would just sort of note something though in the statement, which I thought was pretty important, and that is that the bank has sort of subtly shifted their rhetoric around state-based forward guidance versus calendar-based forward guidance. And what I mean by is that the Reserve Bank has constantly said that they want to see inflation sustainably within the target and wages up around 3% before they increase the cash rate. And they would then say that they don't think that's happening before 2024. Well, this time around, they just took that part out. So they still said they want to see those same conditions, but they haven't stressed the timing of that. And I think that gives them a little bit more flexibility.
Okay. I mean, one thing about Reserve Bank speak, everyone pores over the words. So anything in what came out yesterday was deliberate. That's fair to say?
That's exactly right. They don't make these changes without thinking about them a lot. So as an economist that's trying to work out exactly what message they're trying to send, you look at really what has been changed from the previous month. And so the fact that they did make that tweak, I think, is really just wanting to stress that it's really going to be outcomes that drive their policy decisions, not so much the timeline that they've put around when they think things will happen. And that, of course, is where it comes in with our view. We think that those conditions that they've set themselves to meet before raising the cash rate will be met by the end of next year, which is different to what they've been saying. They think that it's still taking a while before we get to that point where they'll actually need to raise the cash rate.
Okay, just before we get on to interest rates, if I read it as a lay person, though I probably have an economics background, but someone far down the totem pole compared to you, I would think, wow, they're really upbeat about the economy. They're talking about household spending, business investment, and then kind of at the end of the paragraph, they have this but line. It does look at times, though, that the Reserve Bank is pretty confident about the outlook.
I think that's a good assessment. They are confident about the outlook. I mean, they've recognised the risk because of COVID all through this, but they are confident around the outlook. I mean, their economic forecasts around GDP and the unemployment rate are really optimistic. And we agree with that optimism, but where we differ is around what that means for inflation and wages. I mean, they're effectively saying that the economy can do incredibly well, but we won't really get much of a lift in inflation or wages from that. Whereas our view is that, yes, the economy can do very well, but also expect higher inflation and higher wages outcomes if we're doing that well.
Okay, and that's why the Commonwealth Bank and you, Gareth, thinks that the official cash rate is more likely to increase late next year?
Yeah, that's right. It just really comes down to a different view on what the profile for wages and inflation outcomes will look like. It's worth sort of saying that in the September quarter, underlying inflation in Australia rose by 0.7% over the quarter. And if you annualise that, that's getting up around 3%. So we already think inflation's running at least at the midpoint of the target band. We'll need to see another quarterly print or two to actually get that annual rate up. But if you look at either the last quarterly rate or on a 6-month annualised rate, you can see that inflation has already picked up, and that was during a lockdown. So we think that inflation's going to come and surprise to the upside. We also think that the labour market is going to end up tight enough that proper wages inflation and wages pressures will come through. It's probably worth keeping in mind too, we've just had these recent strikes, and that's a sign that workers are getting restless and want higher pay. I think all of that's going to end up generating higher wages outcomes. And if inflation moves higher as we expect, I think what it'll mean for workers and also for unions and the like that negotiate on behalf of workers, that they'll end up pointing to higher actual inflation and saying, well, look, this is where inflation's running. Workers should be getting at least that in terms of a pay rise, and then a little bit more so that real wages aren't going backwards. And that's what we've sort of characterised as being a little bit of a chicken and the egg relationship with inflation and wages. You can sort of get it where, as long as if inflation actually moves first, that can help push up wages, rather than the Reserve Bank's view, which is essentially that wages have got to move up before inflation will move higher.
Stay with me, Gareth. We'll be back in a minute. My guest this morning is Gareth Aird, Head of Australian Economics at the Commonwealth Bank. Is there a chance that, because the Reserve Bank also says that it looks at what's happening overseas, we've seen recently Jerome Powell, the chair of the Federal Reserve, talk about tapering bond buying, and the markets expect US interest rates to rise a couple of times next year. We've seen it happen in New Zealand, Canada, other places. Is it possible that, a rising tide lifts all boats in the next 12 months or 18 months?
Absolutely, and in a lot of ways that's our thinking here. I mean, I think the oddity would be if we didn't end up seeing inflation move up, given it's moved materially higher all around the world, particularly in Western nations where there's been large fiscal expansions. I mean, we have had a very large fiscal expansion here. The data has started to heat up, and we've had COVID-related disruptions, not least a lockdown that lasted for 3 to 4 months for half the country. So if we can get clear air from COVID next year, I think the economy is going to boom, and I think with it will come inflation pressures, and I think we'll find that we're at full employment by the end of next year. The economy will be red hot, and that is very much the appropriate time then to normalise the cash rate off what is a record low level of just 0.1%.
So what is the prognosis for the cash rate beyond 2022? And if the bank doesn't do it, the Reserve Bank doesn't do it, is there a chance it'll have to go harder later?
Yeah, look, there is a risk that they leave it too late and have to do a little bit more, although they have spelt out the conditions for when they expect to raise the cash rate. So I don't think we'll end up in a situation like in the US where inflation is up around 6% and the Fed hasn't yet started to tighten policy. I think the Reserve Bank will end up tightening policy when we get those outcomes. Our view, though, is that they're not going to have to move the cash rate that high to have a pretty material impact on the economy and household finances. Households in Australia carry a lot of debt, and that's in part because interest rates for many, many years have been coming down. So what that means is when interest rates go up, the interest cost on servicing debt actually rises quite quickly, particularly given you're coming off a very low interest rate. So the percentage change in rates is actually quite material for those first few rate hikes. So what I think that means is we'll see that, and when the Reserve Bank gets around to raising rates, they're not going to have to do a lot for it to start to have a pretty material impact on the economy. And that's where we think that this interest rate cycle is only going to end up taking the cash rate around 100 basis points higher from where it is now. A lift in the cash rate of a bit over 1% would be enough to take mortgage payments as a share of household disposable income to a kind of average level. And we think that's the natural point for the Reserve Bank to stop. I mean, if the economy was genuinely overheating and they were really worried about inflation being too high, well, then they might have to go higher than that. But at the moment, we think all they'd be seeking to do is normalise the cash rate, and we think that's lifting the cash rate to around 1.25%.
So I can't talk to the head of Australian economics at the Commonwealth Bank and not ask about the mortgage market, the Commonwealth Bank, of course, being the biggest lender in the country. You had some figures out today that kind of suggested that there weren't as many buyers out there.
Well, look, the housing market is still pretty hot. We need to be clear here, but it has cooled a little bit. And I think the reason that it's cooling is because fixed rates have gone up. And up until quite recently, as in over the COVID period, far more lending than normal was taking place in that fixed rate space. And that was really a function of the fact that fixed rates were lower than the standard variable rate because the Reserve Bank had this term funding facility at work. But what we've seen over the last 6 weeks is that the fixed rates have been moving higher, not just because the term funding facilities expired, but also because the money markets are pricing in higher interest rates. And I think that in turn is going to act to cool the housing market. Of course, we also had APRA come in about a month or so ago and lift the minimum serviceability rate. So all of those forces, as well as some, I think, just fatigue in the market, will act to cool the market. Our view, though, is that prices will continue to push higher in the early part of next year, probably peak around the second half of next year. And then if we're right on the Reserve Bank raising interest rates, well, I think that means home prices are going to move lower over 2023.
Gareth, thank you for talking to Fear and Greed.
Nice to have a chat again.
That was Gareth Aird, Head of Australian Economics at the Commonwealth Bank. This is a Fear and Greed daily interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.